the headline rate of inflation, as you say, is expected to decelerate again to 3.1%. That's well down from when we had 9% in the summer of June 2022. We think there are probably three reasons to expect inflation to continue to decelerate, or at least not surprise on the upside over the coming months. First thing is that the disruption caused by the pandemic is still unwinding. One way you can capture that is looking at the shelter CPI inflation. If there's signs that continues to slow down, it's a good positive signal to drive down the overall inflation rate. Secondly, if you look at inflation expectations, looking at surveys of consumers, the University of Michigan survey shows that consumer inflation expectations are anchored down around 3%. So if these remain fairly low, it probably means that companies won't be raising their prices anytime soon. And again, that puts downward pressure on inflation. And I think the third reason is about the dollar. The dollar's remained strong, so that's kept import prices down, and it also keeps CPI goods price inflation down as well. So it's a combination of those three factors that do suggest that the trend of inflation is likely to decelerate from here.
Right. I also saw your commentary around what a rate cut could mean for equities. You're suggesting that they could add a further boost to the rally we have seen thus far. But ultimately, why? Because even if we get a Fed cut, it could be just of about 25 basis points, and it doesn't really signal to us whether we're going to see further cuts for the rest of the year. So how are you so confident that this could actually improve even further the rally in equities?
Well, firstly, when we look at the expectations of interest rates, they're expected to cut them by 25 basis points, as you say, in September. If the inflation surprise on the downside, they could bring forward those interest rate cuts further. It's also worth bearing in mind that the Fed is actually cutting back on its quantitative tightening. So that's another way to boost liquidity into the system. But I think the bigger picture here is really looking about fundamental earnings. Earnings expectations continue to grow. In fact, globally next year, we're expecting earnings to rise by, or the consensus is by 13%, and that's been steadily accelerating. And I think the key reason for this is twofold. One is that economic growth continues to improve. If you look at the US, the expectations of economists was that the US would only grow by 1.2%, but in fact, it's more than 2%. So it has accelerated. And the second part is looking at those profit margins. I think this is most misunderstood. Profit margins are actually at record highs. And part of this is down to the shrinkflation, where companies are selling products of a smaller size but charging the same price. But also due to the fact that big data has been used a lot more to optimize that pricing power of corporates.
Clear. Daniel, I would also like to understand what sectors do you think will benefit for the rest of the year? So far, this rally has been very much focused on AI names. Anything that this could actually change? Any indications that this could be different for the rest of the year?
Well, we still hold our core holdings is in growth quality names like AI-related stocks. That should be part of your portfolio. But in terms of broadening out, we want to look at other areas that benefit from AI, and that will include things like industrials for production of electrical equipment. If you think about it, if you do a ChatGPT query, it uses 10 times more electricity than a simple Google search. And we need the electricity 24/7, 365 to drive this AI theme. So we think that it might be prudent to start broadening out into other areas of the market that would include industrials and electrical equipment within that.